Well, hi everybody. I did Alibaba in the last, when did I begin this? Probably over the weekend, November the 1st, they had a press release and an announcement, and they covered off on the second quarter numbers, and they surprised everybody, as you could probably see. Let me zoom in a little bit on the revenues growth side of things. They did 41% increase year on year on revenue. Now, you can see some of those they went public in 2012, and they've been running at 75% on some occasions. But really, I think they were projecting they weren't projecting anywhere near 41%, and so the market was caught a little bit surprised. Obviously, the whole China effect and trade issues and possible slowing down or actual slowing down of the Chinese economy came into play, but their numbers were really very positive. Their share price has been obviously affected by all that sort of talk. But when you look at the valuation, you'll notice here that I'm valuing the company at $248, and they're currently trading at $184. Now, how I actually stumbled on them is that I was taking a look sort of every weekend. My little hobby horse is to look at a different sector. And I was focusing actually on the retail sector. And I tend to, if you remember last time we had this conversation, I look for stuff that's been priced, in this case, lower than the market. And it's interesting with Alibaba, actually, because when you look at their fundamentals, and let me scroll over to that screen, like PEs and that kind of thing, they aren't that cheap, really. As you would expect. But what I tend to do is also run a regression analysis against the industry, and that's where they popped up. So you can see here some of the results. For example, PEs, really this is their column over here, and this is I've got a couple of competitor sets that I've looked at. The number 2, 3, 4, and 5, and how that breaks down is this is US retailers. This is developed Asian retailers, this column over here. This column over here is European retailers, and this is emerging retailers. So obviously trying to compare apples with apples, and you can see that they're actually quite expensive. So for example, if you take the ones, I'll focus on the ones where I found some strange anomalies, like EV to RC, they sitting at 5.93, and this, if we compare them to developed Asia, it's they're sitting at
EVs?
Enterprise value. What enterprise value?
IC. What is IC?
Yeah, IC is God. It'll come back to me.
In the cloud?
Invested capital. I'm sorry, invested capital.
Okay.
And so, you know, there you can see that what that's really telling you is that they're far more expensive than, you know, their comparison. And the same for PBV, which is price to book value, 5.44 to 1.11. But what was interesting is that, so this is what the market perceives, right? But then when you run a regression analysis, which is what I do, against and try and get what we call a regression algorithm, if you will, which you can then plug the numbers in, you actually start getting a result which says that they're actually mispriced. So I'm not a big fan of pricing, as you know, but to me, it's a good way to figure out who to do intrinsic valuation on. Otherwise, you just never know where to begin. And so they popped out as showing me that there was something that looked strange there. And it's probably the reason for it is because how the market has downgraded a lot of these Chinese stocks. Anything that's got China in them gets knocked down, simply on the trade effects. But if you start analyzing Alibaba, it really trade has no impact on them, or no impact is not the right way to say it. Very little impact. In fact, when you do a sort of, and maybe that's a good time to segue into like a look at
this. Before you go there, I noticed the sector you regressed against was developed Asia. Is that right?
That's right.
As opposed to, okay. Got it. Yeah.
I did do, I did do sort of a regression against, all the sectors, and then I broke them down and just to see what it yield. But the obvious place to go is developed Asia, because that's where they are competing directly with that size organization. So, it would be large scale. But again, I also looked across sort of the retail sector, and of course they're different in that they're an e-commerce play. They very much sort of have modeled themselves, sort of copycatted Amazon to a degree, but they've done a lot of other things that are really smart. And this diagram here, which I used last time, I'll quickly, for newcomers, explain the axis again. Really what this is it's a value chain, which says, like, at the top of the value chain, the most visible thing, and then it goes all the way to sort of the more invisible things that sort of make their value. How do they get their value? That's what it's trying to answer. And then what it's doing is it's sort of plotting on this axis, what are those things that are more commodity plays, product plays, or like where they're just in the genesis or the beginning of that value chain. And so it just gives me a good way to sort of sketch out where their advantages are. And so if we look at it from the very top, this notion that Asia is the future is sort of coming into play quite a bit nowadays. And there's a lot of literature and stuff on it where, the dominant Asia, it's not really a China play any longer. It's now all about Asia and the Asian economy. And if you start looking at Alibaba, you'll see that the e-commerce, and they don't break these numbers down, unfortunately, but they talk about, their product and their platforms are being used well out of the China mainstream economy into all these other Asian economies, which are, starting to become very digitally savvy. And so that's like an interesting stake in the ground as a starting point. Their sort of mission statement is to make it easy for businesses to do business. And so when you begin, Amazon do a similar thing where they allow retailers to sell on their platform, but Alibaba do this like with everything. So this is all about enabling retailers to play on their platform and not necessarily have to build their own e-commerce platform. So if you go to Alibaba, you'll see you've got thousands, hundreds of thousands of these distributors selling their products on the Alibaba platform. And so really what they consist of is three core components here I put in red because that's where they generate their revenue. Commerce, which they're well known for, but they've been making a serious move into cloud computing, just like Amazon have with AWS. And I think that's a super interesting play because what they're going to do is, as they typically do in Chinese sort of economies, is put major price pressure down on cloud computing. Now, it's not to say that US customers will buy Alibaba cloud computing. They may, but it's not their main sort of play. Their main play is going to be in this Asian economy and providing cloud computing, just like Amazon Web Services does for, Western countries, if you will. They're providing this for the Asian economy. And I think that's like a major play there. And the other big one they've done is digital entertainment, which is really very much like Netflix. And that's why I headlined this article which I'm going to publish on the weekend, but it's really headlined. It's sort of they're going from commerce, they're moving from commerce into cloud via a Netflix play. And so they own a couple of movie studios. They're producing content substantially. And you'll see these arrows is where I've put where I think they're, if they move well into these opportunities, they're going to be really a stock to watch. So content, for example, they have acquired a movie studio and they're starting to produce movies. Again, their focus is on the Asian economy. So if you want to get into the Asian economy, this is the vehicle. And then
so
this uses...
If I can, I'm sorry to interject, let me just make a few points, because I recently interviewed a gentleman by the name of Jeff Towson, who is a professor in Beijing. He calls himself the celebrity professor, and he focuses on Asian tech. So a few comments around Alibaba that I've noticed. First of all, it seems to be much more of a selling of real goods, like manufactured goods type platform. They don't seem to have their own brands as well on their platforms, and maybe something that you can address in the future. He mentioned to me, Jeff Towson, that a lot of these Asian platforms have moved into finance, being able to pay over their platform. So maybe that's something Alibaba has done. You can talk to that as well.
Yeah, no, but that's exactly right. They unlike Amazon, where Amazon have their own branded products and their own inventory, they don't. And so, well, they have that. That's much less of their play. What they are mainly doing is signing up with these manufacturers, hundreds of thousands of them in Asia, and allowing them to sell their product on their platform. And so sometimes you when you go on there, you've got to buy like 100 units of something. Mm-hmm. But that's the e-commerce that they've enabled. And then exactly correct, as that gentleman mentioned, is you'll notice up here, they've got this thing called social commerce, which is really big in Asia, which gives you the ability to buy on your phone using things like WeChat. Now, Facebook mm-hmm. are aggressively moving into that mode, but that's definitely how commerce is done in Asia. So that's sort of a big part of what they're doing. And so they're a platform, and that's very clearly has to be identified. They're a platform that provides commerce, but they're also taking that same platform and all the cloud capabilities that they've provided and are providing Asian firms with this IT environment that they can then use, just like Amazon Web Services have. So, they really, it's going to be really hard for Amazon to come into this space. They are in the space. Of course, you can get Amazon Web Services in Japan and various other Asian countries, but these guys will be they will be the sort of Chinese player, and certainly a low price player. And then I think something else you've got to look at here is that China are very good in artificial intelligence. And so they are able to then wrap their AI toolkits both into this cloud computing and making it available to firms, Asian firms, or you could, European or American firms that to use this on their cloud computing. They're very strong there. Although the American players are also strong, there is a belief that the AI toolkit coming out of Asia is really good. So, this is I think this understanding of what they do, which is well beyond commerce, into sort of becoming the Netflix of Asia, and then of course the cloud computing. This is really where these guys are playing, and so that I think is explaining sort of some of these charts here. Now, they didn't give any indication of where they are going. And so for my analysis, what I did is I said, okay, for the next 5 years, I'm going to project about a 36% compounded revenue growth rate. The operating margins right now, this is a picture of where their operating margins have been, again, like all over the place. So we've only got numbers from 2012, but you can see there's been downward pressure, and I would expect that much. But I think there's a sort of settling in effect. You can see there was an uptick from 19 to 20, from 16 to 19%. And so really what I did in my analysis is I said, I think that this operating margin over the next 10 years, probably sit at about 19%. I think it'll go up and down, but probably average out at that much. And so that's what I used in my analysis. And then the cost of capital is, a little bit higher because there is some country risk in Asia, in China, of course. So it adds a couple of percent to the cost of capital, which obviously then makes the value of the firm a little bit less. And then their beta is kind of interesting. And let me kind of show how that analysis went, because what I did, you can see here are the various businesses that they're involved in. And of course, different businesses have different risks. So there you can see my unlevered beta for the different businesses they're involved in. So obviously retail's the big one, and I did this valuation all in US dollar terms, and therefore I used the US dollar risk-free rate. But you can see that in that business, it's 1.24, and then you've got sort of software systems, which is really their cloud computing, and then entertainment. And so that beta sits all very much at the same. And then they've got this very small business that's sort of beginning, which is just sort of innovative internet products, where they're starting to build some innovative tools. That's what they call proprietary tech that I'm showing down here. Hopefully my mouse is coming across. And so that's that part of the business. So a little bit lower risk maybe there. So anyway, but not making a big difference. So the unlevered beta, which feeds into the valuation, is 1.23. When you lever it up, they have a very low debt ratio, these guys. But you can see my cost of equity, my cost of debt, an equity risk premium, which is all based in China at the moment, because they don't really tell you. We know they're doing business in the rest of Asia, but they don't really tell you enough that you can look at what that impact would be, because some Asian economies are riskier. But at any rate, that's what feeds into the evaluation. Maybe what's a good idea now is for me to show you the valuation, unless there are any other questions.
No, that's good. The gentleman I interviewed, Jeff Towson, he also mentioned how these guys look at the platforms here in the US and they kind of feel that they're a little old, antiquated. He spoke about the whole digital movement in China and how different it is. So that's one thing. The other thing was, it's interesting that they've made a digital media play, given that they're coming from almost a manufacturing sales background. So I wonder how those two, how they thought the one would support the other.
Yeah, but it is sort of typical of what we are seeing. I think they're just copying Amazon to a large degree on a macro level, but then they're applying sort of that Chinese mentality, if you will, which is really pushing the price points down. So I think it's going to be really interesting to see where that goes. This is maybe, if I can digress for a second, like if you're watching the Microsoft space, you've got Microsoft, Google, and Amazon playing in this cloud space. And Google are not winning there at all, but Microsoft have made a major move, and their results have been phenomenal. But they've taken the place of the Rolls-Royce sort of thing. They give you this tremendous cloud platform where you don't need engineers to run it in your business. Amazon provides you with this powerhouse stack, but you need engineers to run it. Both of them are pretty pricey. At the end of the day, they start with, your entry is very low, but you get sucked in, and before you know it, you're spending millions of dollars to them. These guys are going to be different, in my opinion. Where they're going to play is they're going to sort of provide the same stack of services, as you said. They will emulate that, because most of the services that are available on the cloud are open source components, and they just make them available on a cloud network and optimize them for you. But what I think they're going to do is bring in this low cost structure, which is going to apply pressure potentially to Amazon. We'll see if the US businesses and European businesses will buy Alibaba cloud services
right.
On scale.
They may consider it a security risk.
That's the whole, that's that whole side of things, which we see playing in 5G. So here we have the valuation. Let me maybe jump to right away to the outputs tab, and some of the things. Let me just open up the spreadsheet a bit. Maybe what I'll do is work backwards and just show some of the numbers. We won't go into every little detail, and then I can cover off on questions. So down here at the bottom, you can see there's the bottom line value is $248 that I got to. So, how did we get there? So you can see there's my revenue. As I mentioned to you, over the next 5 years, I put them growing at 36% on average. I think we're gonna see those oscillations that I showed you in the graph, but I think that's where it'll average for the next 5 years of this sort of high growth phase. And then really what I do, which is just conventional valuation approach, is that as I head towards a terminal year, which is year 11 onwards, I just grow them at sort of the growth of the land them at the growth of the economy, which is the current risk-free rate of about 1.68%. And so I just drop them down to that on a sort of linear basis all the way down. And so that's how I sort of projected their growth. And then, so that gives me my revenue numbers. And then my operating margin, as I mentioned to you, I sort of level them out at that their current sort of margin. Again, there's it can go, this of course are the unknowns, predicting into the future, but you do the best you can. So I think that, what you'll find happening is that I'm thinking that that's where they'll settle down from a margin perspective and sort of average out at that number. And then their tax rates are actually at the moment pretty low, and you can see they grow up to the marginal tax rate in China is 25% also. Okay. So I take them up to that number. And then essentially this reinvestment number is an interesting number, and let me quickly digress and talk about that one. Just going to flip back to the spreadsheet. And you can see I use that same measure we talked about for when we did the other valuation, but I use the sales general dynamic. I use the sales to capital ratio. And so you can see here that over their history, obviously in this early days, you've got this sort of abnormal blip that sort of occurred, but they seem to have settled down to the sort of 3.2, 2.44. And so the way you use that, this is very useful because it's really difficult in an evaluation everything is difficult in evaluation, from figuring out all those numbers I just showed you. But the most difficult thing is trying to figure out how much they're going to reinvest every year. And obviously it's, that's just a thumb suck. What's their CapEx going to be? How are they going to sort of pay off their debt? What's their working capital requirements, that type of thing. So you use this number as a sort of surrogate, or it really helps you get an idea of this metric. So if I flip back to my sheet,
it seems quite stable from 2015 onwards.
That's right. Quite stable, which is good. But I do suspect, like they did indicate on the call, that they're going to be reinvesting quite heavily. Because this cloud will require that. But so that's how I got to my reinvestment, as I used that ratio to essentially get this sort of number here. You can see it following all along. And then I get my free cash flow to the firm, and there is a net operating loss of 12.455 that you can see coming into the valuation over there. And so that's just taking that into account. And then my cost of capital that I mentioned to you is driven through there. And so ultimately, you've got your present values, and let's talk about it here. So you've got your terminal year, which is year 11 onwards, which is obviously generates the biggest number. And then you've got your terminal cost of capital, which gives you your terminal value. And then you've got your present value of your terminal value. And then you've got all those cash flows that you saw over there, which I've present valued and brought it in. So there's your sum. And then, although you see a number here for proceeds, there isn't, I put a 0 chance of the firm failing. And so that number you can ignore. And then I subtract out my debt and minority interest, add back in the cash, add any non-operating assets that they've got, value of the equity. There are options and RSUs that have been issued, and you need to take those out. Essentially, you come down to a value of the equity, number of shares in issue, and divide that, and you get this $248 a share, which so that's kind of how this model was built.
Okay.
Now let's obviously that's a point in the ground, and who knows what will actually happen. So what I always like to do, which I can't remember if I got to with my GD one, is I like to run a Monte Carlo analysis. And let me actually go to that first and foremost. So here it is over here. And I ran this a couple of evenings ago. And so I ran 100,000 simulations. And essentially what I did is I varied those key parameters that you saw, like the revenue growth rate. I think I used a normal distribution as an example. I won't go into each one. For that one, I said, remember we said we put a stake in and we said it was 36%. Well, I ran a normal distribution, which I think was all the way from 30 up to about 42%. And I applied that. And then for the operating margin, which, as you know, we said was 19%, I ran, I think, a triangular distribution for that, if memory serves me correctly. And so I ran various distributions for that. I also changed the sales to capital ratio and applied a distribution to that. I think those were the three. I'll come back and look at my assumptions in a second. But that's the curve that it sort of gives you after running that, which really says to you, look, the medium price is running at about $233. So let me come back to this, which is sort of a better high level. Here it says, it gives you the details of what I ran, if that's of interest. And I will publish this page out and give you the link to it. But what you can see, what this is really saying is that it's forecasting, at the 50 percentile, about 238. So slightly less than the 248 we mentioned. It's pulling that down just a little bit. But what's interesting, because the share price is now sitting at 184, and really what this is saying is that there's a 10 percentile chance that it's going to be less than that. So it's really saying that what this is, the way to interpret this is saying that the upside does look fairly positive, with all the changes. Now, obviously, things can go, there's always the chance that things can go nuts. But if you just apply some, reasonable assumptions to this, the most likely number it's going to settle on is that 238. There's a 90 percentile chance that it'll get above 290. So, I think how to interpret this is if these numbers here, if we sort of get another year and they're looking like they're trending in that 40% range, and if the margins are not impacted and they're also sitting at that 90%, I think there's a very good chance that the stock price will move to that 238 to 248 range.
Okay. I'm having a look at a long-term stock price here. Yeah, I mean, that looks good. So one question I always have when it comes to Chinese valuations or Chinese equities is, how much of this is a free capitalist market in the sense of to debt, leverage obviously is debt, and revenue growth. I mean, how free are they to, to grow at that rate. And I guess, I don't know if you know this, but when does, Chinese politics come into play?
Yeah, I mean, there is that risk element. And, the answer to that is really difficult. I mean, all I can do is if you listen to the earnings calls, for example, it sounds, everything sounds exactly as you would hear from a US company. When you look, obviously I pulled all these numbers from, they don't call it a 10K, but I think it's called a 6K or something. It's the equivalent, which, because this is listed on the, I think it's
ADR,
NASDAQ.
right?
No, you can buy this on NASDAQ.
Okay.
Yep.
Got it.
And so they've got the SEC requirements to go through. So, but at the end of the day, so it's just my intuition. That's all I can give you. I think this is you can treat this like any other company. I don't think the government intervenes that much in this kind, if at all. Now, do they get favorable sort of contracts? Because a lot of their cloud computing is designed to be sold into Chinese governments, and they disclose that in their in that earnings call. So that does come into play, but it's I think the way I look at this is if you want to play the Asian economy and this concept, of the future is Asia, and then I think it's an opportunity that I think they're one of the best Chinese players out there. There's a great book that I've that sort of got me. I read this. There's a guy by the name of Parag Kahana, and he's written The Future is Asia. I think it came out a couple of months ago. And when you read it, then you begin, if you believe what he says, which he starts basically talking about what is Asia and what is the Asian economy all about. And he says it's far more than China. Because these guys, for example, I didn't mention, they've made acquisitions of e-commerce firms in other regions of Asia. So, it's just to me, it sounds like a really interesting play if you go with that premise that the Asian economy is going to be the dominant economy in the next 10 years. Maybe together with the US, I don't know. But it's certainly that, US, Asia, and Europe. And they've taken a different view from the EU view, which was sort of, a governance structure. The Asian structure is far more informal. It's these very informal ties that sort of create this big engine. What I wanted to do is quickly show you, I'll show you where we brought risk into this, because that's what your question is really all about. It's like, how did you, what's the risk? So in the cost of capital worksheet, so, you can see, let me just make this a bit bigger. So, you can see over here that, oh, the spreadsheet is not updated, sorry. Okay, I've got another sheet, which I'll see if I can quickly dig out and it'll make more sense.
Whilst you're doing that, maybe you can comment on the recent, I think there was a CEO change where Jack Ma is, I guess, kind of moving out, and he was such a figurehead. He was the founder of the company.
Yeah, that's right. He was, but I think that announcement was sort of maybe I think maybe 6 months ago. So in this current earnings call, and so I would urge folks listening to this to listen to that call. It was on, I think it was November the 1st. And so you'll hear the new sort of regime in there. And I think in typical Chinese style, it's like, a pretty fluid transition. I just didn't feel like there was again, these things are just personal views, and I guess everybody listening could have a different take, but it felt very fluid and very structured. This feels like a very well-run, well-structured sort of machine. That's my interpretation. I guess, different people could interpret it, differently. But, so here you can see China coming in. And so part of your calculation of cost of capital is something called an equity risk premium. And so there's a couple of percentage points here which are added on, and I'll show it to you in this spreadsheet here. So for example, China, which is a little below here, over here, has a risk premium of about 0.79%, which is added, really accounting for the potential risk. And so obviously that's making your cost of equity higher, and which then makes the valuation lower. So that comes into play over there. And then also it comes into play.
And that data is from iCapital, is that right?
No, this data is actually from Aswath Damodaran's website, where he publishes this twice a year and makes this available. He's a professor at Stern Business School. I may have mentioned it last time, I can't remember. So that you get this data available, and it's commonly used in sort of all these valuations, but it's known as the country risk premium. And so every country attracts obviously, except, US doesn't, and a couple of those other ones, but they all attract a particular risk premium. And then what you're doing is so you're applying that. It's also on your cost of equity side, but it's also on your cost of debt. So how do you do your cost of debt? Just as an interest for folks, you essentially get your book value of your debt, you get your interest expense, and you create what we call a synthetic rating. So essentially we have this lookup table over here, which says their interest coverage ratio of Alibaba is 14.09. If you look it up, that's a AAA debt. And if you look that up, you can get the spread for that, which is a 0.75 spread. And then you add that default spread that I showed you a little earlier onto that. And so that takes it up to 3.08%, which is still very low from a cost of debt point of view, because their debt structure is very clean. But you can just see that it is building in that risk factor that you sort of asked me to give on. And it's surprisingly, my internet connection's unstable. I hope I don't sound unstable. But yeah, that's where that comes into play.
Anyone who believes Alibaba is going to $248 is unstable, I think.
Well, I hope, I do.
No, just kidding.
I know you're kidding, but I do put my money where my mouth is with this stuff. So I did invest in them after I did this analysis, and they have been moving. They've been moving quite steadily. I've got a sell order in at 200, so we'll see. Hopefully we'll reach there in a couple of months. Yeah,
as of this speaking, it's at $186, so that's looking good. Well, listen, Mel, thanks very much for the great analysis. We'll be watching. What is the time period generally that your forecasts work over? 1 year, 3 year, or?
Well, I mean, this is really, this is saying, sitting here today, let's value the company. And the way you typically are valuing a company is you're saying you're forecasting into the next 10 years, but then you're saying it's a going concern. So you've got that, that residual value that you want to bring present value. So you're saying, if these are the fundamentals behind the company, then, and typically what it's saying to you is if the next quarter results sort of come in on tune with this is where the market should be valuing this company. Really what my observations, and this is just my interpretation, you'll get it. Every person opens a spreadsheet will get a different interpretation. My interpretation is saying, I think the market is not pricing this thing correctly right now.
Right.
That's what I'm saying. They're mispricing it, and I think that it should be priced at a high. Now you could see that, when I told you I've put in a sell order, I haven't put it in at 230 or 240. I put it in at 200. I'm saying there's a mispricing, and I think there is a movement upwards, and I think it's a fairly good risk proposition that it'll get to 200, and then I'll move on and sell it.
Yeah. No, I got it. To paraphrase, it's the Warren Buffett or Graham and Dodd's intrinsic value, and that stocks trend to their intrinsic value over time. Okay, well, good. I think we'll be watching this one with great interest. So thanks for that. And any final comments before we wrap up?
Nope. This is, if you're interested in another sector, let me know. Or I play a little bit with broadcasting, but my problem is I run out of time because I have a real day job. But if there is any interesting sector, I'm happy to, do a deep dive and see what comes out of it.
All right. Let us know if there's any good sectors. All right. Thanks again. Appreciate your time today. Take care.
Take care. Bye.